Mortgage rates have been on the rise, so much in fact that daily rates have been above 7% every single day so far for the month of August. And on top of that, they jumped to a 23-year high last week. Additionally, so far this month of August, 28 days in, there's only been 4 days in which rates decreased. In today's video, I'm going to share all the details, plus some more housing market news as well, so you guys can be more informed. On top of that, I'm going to share some economic reports that will be published this week, which could cause some volatility in our market. And by the way, if you guys are new here, I invite you to subscribe to this channel right now because I post frequent housing market updates so you guys can make a more informed decision about whether to buy or sell a house right now. And with that said, let's begin today's video. I appreciate you. So here are daily rates according to the Mortgage News Daily as of today, which is August 28th. Happy Monday, everyone. Or you guys are probably watching this on Tuesday. Anyways, average rates today, which is Monday, is at 7.29%. A fairly significant decrease compared to Friday because rates decreased by 10 basis points. But again, we've only had 4 days so far, 28 days in which rates actually decreased on a daily basis here. Also, average rates for people with great credit again for FHA is at 6.88% and VA is at 6.90%. When looking at rates 1 year ago, the average was 5.73% or an increase of 1.56 percentage points over the past 12 months. Also, when we look at this chart above here, daily rates have been above 7% ever since July 27th this year. I like to share multiple sources of rates though. So according to Investopedia.com, as of August 28th, the average 30-year fix is at 7.73%, much higher than the Mortgage News Daily at 7.29%. Again, though, this is all for people with great credit and also for people putting at least 20% down and also having or also buying a primary residence as well. If you're buying a rental property and or if your FICO score is below 740, you're not going to get these rates. It's probably going to be higher than these advertised rates on the Mortgage News Daily as well as Investopedia.com. Let's also have a look at average monthly rates as well, because according to Freddie Mac, the average 30-year fix so far for the month of August is at 7.05%. 1 year ago, the average rate was at 5.22%. Now here's where it gets really crazy here. Let me just look at the max. Going back to, what was this, April 1971. So the monthly rate at 7.05% is the highest rates going all the way back until December of 2001. Also, just for fun, back in the 1980s, let's just call it back in October 1981, the average rate was at 18.45%. But of course, home prices were much lower then compared to now. Let's also have a look at the forecast for the federal funds rate, which is controlled by the Fed. A good website for that is the CME Fed Watch tool. I'll leave a link in the video description below for this. This actually provides a forecast for changes of the federal funds rate based on upcoming meetings by the Fed, which is their FOMC meetings here. So for the month of September, their next meeting on September 20th, which is in 22 days from now, they're forecasting that the federal funds rate is going to maintain at 5.50%. Only a 21% probability that the Fed is going to increase rates to 5.75%. Then in their next meeting, which is November 1st, take a look at this. A 50% probability that the Fed is going to increase rates by 25 basis points to 5.75%. Then in their last meeting of this year, which is December 13th, one day after my mom's birthday, they are actually forecasting for rates to maintain at 5.75%, at least by a 47.5% probability. Now, having said that, these forecasts here change daily based on new economic data here, but that's what their forecast is, at least as of August 28th this year. So one reason why I'm mentioning the forecast for the federal funds rate even though that does not control mortgage rates, it does impact it in an indirect way here. And here's a really good chart showing just that. The red line right here is the average 30-year fixed rate, mortgage rates. And also the blue line right here is the federal funds rate, which is the short-term rate that banks charge each other, and also the rate that is controlled by the Fed. What's pretty wild is that I actually kind of forgot about this, but in 2009 through almost until 2016, the rate was at more or less 0%. When the rate was that low, mortgage rates were decreasing, or they were decreasing from the 5.25% we saw back in more or less 2008. Rates decreased once the federal funds rate decreased, and then once the Fed started raising rates back in 2016, rates did increase as well. And then of course we had the pandemic. Rates decreased down to 0% again, and that caused mortgage rates to decrease as well. And of course, we saw a huge increase, the biggest increase in the federal funds rate that we have virtually seen ever. And that of course caused rates going from 2.7, 2.8% now to approximately 7.30%. And I'm circling this, but this is an old chart going back to the early parts of 2023. But of course, today's rates are right around right here. In any case, even though the Fed does not control mortgage rates, it does have an indirect relationship, as can be seen by this chart here. Here's what we also know as well. Because prices and rates have been increasing, especially compared to the past several years, housing affordability is becoming a giant issue, which I talk about on the channel pretty often, right? So here's a new report from the MBA posted on August 24th. It says here, homebuyer affordability for the month of July was challenging, but mostly unchanged from June. This is based on the MBA's Purchase Applications Payment Index, or their PAPI. It's a funny acronym. Their PAPI is based on monthly mortgage payments relative to income based on their weekly survey of application data. So they look at the income of applicants, so people who are applying to buy a house, for example. They look at their income that is stated on their application, plus they look at what would be their average monthly housing payment as well, and they come up with their PAPI. It sounds like a Seinfeld episode. Anyways, their PAPI. Prospective home buyers continue to face challenging conditions this July, with elevated and volatile rates and low housing inventory serving as a 1-2 punch that suppressed applications and sales activity. I will add to this, we have low inventory levels, I should say, volatile rates, but on top of that, overall, we still have very high home prices as well. So I would say this is a 1-2-3 punch for home buyers right now. And it says here, with mortgage rates currently above 7%, and expected to remain above 6% by the end of the year, affordability will remain a hurdle for many households looking to buy a house. So on a national level, their PAPI decreased by 0.9%. Their index is at 175.6 this July. So here's what this means when their index actually increases. This means that borrower affordability actually is getting worse, which means that your mortgage payment to income ratio is higher due to increasing application loan amounts, rising rates, or a decrease of earnings from that borrower. In contrast, a decrease in their PAPI means that borrower affordability is actually improving, which occurs when loan application amounts decrease, rates decrease, or earnings increase. So for the month of July as a whole nationwide, the PAPI decreased by 0.9% this July. It says here though, while the index decreased slightly last month, this index still remains at elevated levels. Very close to all-time record lows here, or I should say all-time record highs, meaning housing affordability at nearly an all-time record low. It says here the median earnings were up by 3.7%. So earnings by applicants increased by 3.7% compared to 12 months ago. However, though, payments or mortgage payments increased by 17.2%. Can you say not sustainable? You can't have earnings increase by 4% and have average monthly housing payments increasing by 17% and not expect some sort of pullback in the months ahead here, right? I say this often, can you say not sustainable, right? Here's a look at their index though, going back to 2009. As you can see right here, their current index, which is the blue line here, is very, very close to all-time record highs, meaning housing affordability at all-time record lows, going back to July of 2009. Let's also talk about what's ahead this week, because there's a lot of reports that is going to get published that's really going to impact rates this week here. Regardless of rates though, I do want to mention this because tomorrow, which is Tuesday, August 29th, the National Association of Realtors will post their PHI, or their pending home sale index, a measure of contracts being signed between buyers and sellers. That's being posted tomorrow, which is probably today when you're watching this video on Tuesday. And of course, I'll make a video on that. So that has nothing to do with rates, but also there's also going to be the JOLTS, which is our jobs opening report on Tuesday as well. That will impact rates likely as well. And I just add this for fun because I used to make a monthly video of the S&P and Case-Shiller Home Price Index. But look at this. On Tuesday, August 29th, they're going to post their index based on home prices nationwide for the month of June. It's basically 2 months behind. That's why I don't share that report anymore on this channel. Nothing against the report, but it's very much a lagging indicator what our housing market was like several months ago. And that's why I don't talk about it on the channel anymore. Anyways, on Wednesday as well, we also have the MBA's purchase index, which is a measure of the amount of people submitting applications for home loans to buy houses. They post that every Wednesday. Of course, I'll make a video on that as well. But also on Wednesday, we also have the ADP jobs report as well, posted on 5:15 a.m. on Wednesday. Then on Thursday, we have the PCE price index, which will be posted then. And that is the preferred measure of inflation by the Fed. So the Fed will keep a watchful eye about that report, and that will likely impact rates on Thursday. Then on Friday, we have the non-farm payrolls report, reporting on 5:30 a.m. Pacific Standard Time on Friday. So a lot to share in today's video. Of course, a lot of news ahead here as well. So thank you so much for watching today's video. I appreciate you. Hope you have an awesome day. I look forward to seeing you on the next video.